One of the most common questions borrowers ask is if the Federal Reserve rate is around 5%, why are mortgage rates over 6% or 7%? Or sometimes people say the Fed cut rates, so why didn't mortgage rates drop? This confusion happens because many people believe the Federal Reserve directly sets mortgage rates. But that's actually not how it works. Mortgage rates are determined by investors in the bond market, and the difference between mortgage rates and government bonds yields is called the mortgage spread. Today, I'm going to explain what the mortgage spread actually is, why mortgage rates are always higher than the Fed rate, why the spread sometimes widens dramatically, and what needs to happen for mortgage rates to fall significantly. By the end of this video, you'll understand exactly why mortgage rates behave the way they do. Let's get into it. First, we need to understand what the Fed rate actually controls. The Federal Reserve sets something called the federal funds rate. This is the overnight interest rate banks charge each borrower to borrow money. It's a very short term rate, usually measured over one day. It influences things like credit cards, home equity lines of credit, adjustable rate loans, short term lending between banks. But mortgage rates are long term loans, typically lasting 15 to 30 years. Because of that, mortgage rates are influenced much more by long term bond markets, not overnight lending rates. Mortgage rates tend to follow the 10-year Treasury yield, not the Fed rate. Why the 10-year? Because the average life of a mortgage is much shorter than the 30 years. Most homeowners refinance, sell their home, or move within about 7 to 10 years. So investors compare mortgage bonds to 10-year Treasury bonds when determining yield requirements. Historically, mortgage rates are usually about 1.5 to 2.5% higher than the 10-year Treasury yield. That difference is called the mortgage spread. The mortgage spread is simply the difference between mortgage rates and the 10-year Treasury. Let's look at an example. If the 10-year Treasury is 4% and the average 30-year mortgage rate is 6.5%, the mortgage spread is 2.5%. This spread exists because mortgage bonds carry additional risk that Treasury bonds do not. Investors demand higher returns on mortgage bonds because mortgages have several unique risks. The first is prepayment risk. When interest rate falls, homeowners refinance. That means investors lose higher yielding loans sooner than expected. The second risk is credit risk. While many mortgages are backed by government sponsored enterprises like Fannie Mae and Freddie Mac, there is still some risk associated with borrower defaults. The third risk is servicing and operational costs. Mortgage loans require ongoing administration, payment processing, and compliance management. Because of these risks, investors require a higher yield than government bonds. That's why mortgage rates are always higher than Treasury. When mortgage spreads get wider, sometimes the mortgage spreads become much larger than normal. Historically, the spread averages around 1.7% to 2%. But during certain economic periods, spreads widen significantly. For example, during periods of high inflation, market volatility, low investor demand, mortgage spreads can increase. In some recent years, spreads expanded to over 3%. This caused mortgage rates to remain elevated even when Treasury yields were not rising as quickly. When financial markets become uncertain, investors demand more compensation for risk. Mortgage bonds are more complex than Treasury bonds. They include prepayment risk, interest rate volatility, and housing market risk. If investors are unsure about the future direction of rates or housing, they require higher yields to compensate for that uncertainty, which pushes mortgage rates higher. The Federal Reserve can indirectly influence mortgage rates through mortgage backed security purchases. When the Fed buys mortgage bonds, it increases demands. More demand pushes bond prices higher. Higher bond prices lead to lower mortgage rates. This is exactly what's happening during the pandemic. The Federal Reserve purchased trillions of dollars in mortgage backed securities, which pushed mortgage rates to historical lows. But when the Fed stops buying those bonds, private investors must step in. And those investors usually demand higher returns, which pushes mortgage rates up. For mortgage rates to fall significantly, a few things typically need to happen. First, inflation must decrease. Lower inflation allows bond investors to accept lower yields. Second, the 10-year Treasury yield must decline. This typically happens when the economy slows or investors move money into safer assets. Third, the mortgage spread must tighten. If investors' confidence improves and demand for mortgage bonds increases, spreads may shrink back towards historical averages. If all three of these things happen simultaneously, mortgage rates can fall quickly. Another confusing thing borrowers notice is that mortgage rates sometimes fall before the Fed actually cuts rates. That's because bond markets are forward looking. Investors try to anticipate future economic conditions. If market believes the Federal Reserve will cut rates in the future, Treasury yields and mortgage rates may begin falling months before the Fed actually acts. This is why mortgage markets sometimes move ahead of the central bank decisions. So the next time you hear someone say mortgage rates should be the same as the Fed rate, now you know why that's not true. Mortgage rates are influenced by the 10-year Treasury yield, investor demand for mortgage backed securities, inflation expectations, and the mortgage spread between bonds and government debt. Understanding this relationship helps explain why mortgage rates behave the way they do. If you want to better understand how mortgages, interest rates, and lending really work behind the scenes, make sure to subscribe. On this channel, I break down the mortgage industry from the inside so you can understand exactly how financing decisions are made. And as always, I hope this helps.